What if the biggest crypto bull run in history hasn't happened yet, and 2026 is where everything truly changes? Not because of hype. Not because of memes. But because of macro forces, institutional capital, and ETFs quietly aligning behind crypto. Today, we're breaking down why crypto will explode in 2026, and why most retail investors won't see it coming until it's already too late. If you've been in crypto for a while, you already know this market moves in cycles. But what's coming next is fundamentally different. In this video, you'll learn the macroeconomic forces setting the stage for a massive crypto expansion, why institutional investors and Wall Street are positioning years in advance, how Bitcoin and Ethereum ETFs change demand permanently, and most importantly, why 2026, not 2024 or 2025, could be the real breakout year. This isn't speculation. This is structural. Let's walk through the data, the incentives, and the capital flows driving the next phase of crypto adoption. Section 1. The macro forces no one can ignore. Let's start with the big picture. Crypto does not exist in isolation. It responds directly to macroeconomic conditions, and right now, those conditions are quietly becoming extremely favorable. Global debt and monetary expansion. Governments worldwide are carrying historic levels of debt. Servicing that debt requires one thing: continued monetary expansion. That means persistent currency debasement, structural inflation pressure, and declining purchasing power over time. In that environment, hard assets outperform. And Bitcoin, by design, is a digitally scarce asset with a fixed supply. As traditional currencies weaken, investors don't ask if they need alternatives. They ask where. Interest rate cycles and liquidity. Historically, crypto thrives when interest rates peak, liquidity conditions improve, and risk capital begins flowing again. By 2026, the probability of lower rates and renewed liquidity is significantly higher than today. This creates the exact conditions under which speculative and growth assets, including crypto, tend to surge. Section 2. Institutional capital is positioning. Early retail investors react. Institutions position. That distinction matters. Why institutions move before the headlines. Large financial institutions don't wait for price confirmation. They move when regulatory clarity improves, infrastructure matures, custody and compliance risks are reduced, and that's exactly what's happening now. By the time retail investors feel comfortable, institutional capital is already deployed. Crypto as a portfolio allocation. For institutions, crypto is no longer viewed as a gamble. It's increasingly treated as a non-correlated asset, a hedge against monetary instability, a long-term asymmetric bet. Even a 1 to 3% allocation from pension funds, asset managers, and sovereign wealth funds represents hundreds of billions in potential inflows. This isn't about belief. It's about risk management. Section 3. ETFs change the game permanently. If there's one structural catalyst investors consistently underestimate, it's crypto ETFs. Why ETFs matter more than you think. ETFs remove friction. They allow institutions to gain exposure without holding crypto directly, advisors to allocate client capital compliantly, retirement accounts to access Bitcoin and Ethereum. This dramatically expands the buyer base. Unlike retail trading, ETF inflows are sticky or long-term and do not panic sell easily. Once capital enters through ETFs, it tends to stay. Supply meets structural demand. Now combine ETFs with Bitcoin's fixed supply. Every ETF inflow reduces available supply on exchanges. Over time, this creates structural supply pressure, not speculative spikes. This is why many analysts believe ETFs won't just drive price appreciation, they will fundamentally reshape crypto market dynamics. Section 4. Why 2026 is the inflection point? So why not 2024? Why not 2025? Because markets move in lags, not headlines. The delayed impact of capital flows, ETF approvals, institutional onboarding, and regulatory clarity don't create instant price explosions. They create foundations. Historically, capital deployment happens slowly. Conviction builds over multiple quarters and parabolic moves come later. By 2026, we see ETFs fully integrated into portfolios, institutions increasing allocations after initial performance validation, retail returning due to rising confidence and visibility that convergence is where explosive growth happens. Psychology always follows price. Retail interest always peaks after institutions are already profitable. By the time mainstream narratives shift from, "Is crypto dead?" to, "Why is crypto everywhere?" price discovery is already underway. Section 5. What this means for you as an investor. Here's the strategic takeaway. This cycle will not reward emotional trading, chasing green candles, short-term speculation. It will reward long-term positioning, understanding macro context, and recognizing structural adoption trends. The biggest gains are often captured before certainty, not after. Let's recap. Crypto's potential explosion in 2026 is driven by macroeconomic pressure forcing capital into scarce assets, institutional adoption accelerating quietly, ETFs unlocking massive, long-term demand, and a delayed but powerful market response. This isn't about hype. It's about infrastructure, incentives, and capital flows aligning. The question isn't whether crypto survives. The question is who positions early enough to benefit. Now I want to hear from you. Do you believe 2026 will be crypto's real breakout year, or do you think the market peaks earlier? Drop your perspective in the comments. If this analysis added value, like the video, subscribe for future macro breakdowns, and turn on notifications so you don't miss what's coming next. Because in this market, information compounds just like capital.